Let me say something that might feel a bit uncomfortable, but if you're an NRI in your 40s, still investing like you're in your 30s, then you might be taking far more risk than you actually realize. And if you're investing like you've already retired, then you might be quietly killing away your future. If you're watching this video with a mindset thinking, I know I've figured out exactly what I'm going to do with my investment, then what I'm about to say might feel negative. But if you watch it with an open mindset, then this might potentially help you grow and understand your investment far more better, and you might feel far more confident in your money again. If you're new here, welcome to B&IE. My name is Wilf. I've been living in the UK for the last 15 years, navigating through different financial circumstances, so you don't have to. And if NRI money it feels overwhelming for you, then you've come to the right place. If you want calm, practical financial advices, then stay subscribed. Let's go. In your 40s, this is the most misunderstood decade for money. You're earning really well, you're focused, and your life is quite busy as well. But here's the thing that no one is actually telling you. If you're in your 40s, your margin for mistakes is shrinking, even if your income isn't. The goal at your 40s is quite simple. Continue to grow your wealth, but start thinking about protecting it. When you hit your 40s, you start thinking about debts. One of the biggest debts that you tend to focus a lot is overpaying your mortgage. Trying to overpay that and try to clear off a debt which normally charges you between 4 and 5%, or sometimes even 6%, where depending on the country where you live in. When you actually overpay your mortgage, you're losing the opportunity to grow that money elsewhere, which normally gives you between 8 to 10%. At this point in time, overpaying the mortgage actually doesn't make any sense at all. You're locking away that money permanently, and the only way you can get that money back is to sell your property or take out a home equity line of credit, and that means adding more debts. Think whether you should be overpaying something that is only charging you between 4 and 5%. When you're overpaying your mortgage, you lose the flexibility, you also lose the opportunity to create liquidity, and you're losing the opportunity to actually grow your wealth. Mistake number 2, chasing big wins. And when I say big wins, in your 40s, you think that you can take massive amount of risk. And one of the risks that most people tend to do is to try and put away your money or your savings into risky assets such as Bitcoins. Most of the people tend to enter the Bitcoin realm when the market is really high. You will enter at the peak of Bitcoins, and guess what happens? And then boom, the crash happens. When that happens, you get panicked and you put, let's say, £20,000 or $20,000 into it, and all of a sudden it's gone down by half. At that point in time, your money is locked away. If you take out by selling your Bitcoin, you make a major loss. But if you stay invested, your money is sitting there not making any returns for years. In your 40s, this is a decade for making smart investment decisions, not chasing some hot tips, because this is the decade for you to build your foundation strong. And when you build your foundation strong, 50s will feel like a breeze. Mistake number 3, investing in one single market. And I'm guilty of that as well. Now here's the truth. As an NRI living abroad, you're earning abroad, you're spending abroad, your future is also going to be abroad. Why should you be investing just in one single market alone? And with the NRIs mindset, we always look at the Indian market and think that, okay, that market is actually growing really well and it is giving good returns. But what you don't realize is you're moving a stronger currency into weaker currency, investing that money in the Indian market. When you have made that profit, you pay taxes out there in that country, as well as taxes when the money is moved to abroad as well. When the time comes to you to move the funds abroad, your currency, the Indian currency, has depreciated by 5 to 6% year on year. At that point in time, even if you have made 10 to 12% return, you are literally straight away losing 5 to 6% in currency conversion alone. At that point in time, investing in Indian market makes absolutely no sense at all. You can still be part of India's growth, but there is different ways to do that. Stage 2 is the most important and vital stage of how you approach your investment. This is the stage where you will need to realize how you're going to be investing, how much money you're going to be investing based on how much your risk appetite is. One of the ways that you can do that, depending on whichever country you live in, I'm going to be taking specific example of what is available here in the UK. We have something called a stocks and shares ISA account, and you can open one with one of the companies such as Trading 212. Open an account with them and you can invest up to £20,000, or you can deposit up to £20,000, which you can then utilize to buy stocks, shares and ETFs. I wouldn't recommend you picking individual stocks. Instead, go ahead and pick up ETF, an index-linked ETF such as S&P 500, FTSE All World. You can invest into emerging market, which also concentrates on Indian stocks, so you don't miss out on the opportunity of India's growth. For the folks who are living in the US, you have the 401k, you have the Roth IRA, and the other people across the other globe might want to look into what's the tax efficient options available for you in your country. Pick one and open an account and start investing. ETFs beats even the best of the best stockbrokers. It's the most easiest and the stress-free way of investing. You can pick just 3, if you ask me, to invest, such as S&P 500, which concentrates on the US market alone. You've got the Vanguard S&P 500, then the Vanguard FTSE All World ETF, which includes America and the rest of the other countries. And you can pick an emerging market as well. So that way your money is spread across everywhere, not just concentrated on India alone. What you're trying to do at this stage is not to try and beat the market, but instead you're building a strong foundation for your wealth to grow. I've seen a lot of people who earn quite a good sum of money annually think that savings is the way to feel secure. And they are earning somewhere close to £50,000 or £60,000. What they tend to do is they put away all the remaining money into savings, and it feels secure because it's sitting in the bank and you can actually see visually, and you're not thinking whether it is going to grow or not, but you're not giving the opportunity for that money to grow. Instead, you're just financially feeling comfortable looking at it, that, you know, okay, fine, if something happens, I can always dip into my savings and take that money away. But that money is slowly losing its value due to inflation each year. So don't just put that money into your salary account where the money gets deposited each month by your company. Instead, build an emergency fund. Calculate your monthly expenses. If your monthly expenses of, let's say, to mortgage, to groceries, the fuel, the mobile broadbands, all the expenses that you have each month that you have to pay, calculate what's the total. Generally, here in my household, our monthly expenses are between £2,000 to £2,500. Calculate that and multiply that by 3 or 6 months. And once you've got the figure, that becomes your emergency fund. If anything goes wrong, you can always go ahead and dip into this pot and take that money and be financially free and not worry about what's going to happen. Go ahead and build that emergency fund. And once you've built that, put it away in a high yield savings account or high interest paying account. That way, whatever the money is sitting in that bank account is also growing as well. So you're giving that money the opportunity to grow. Once the emergency funds have been built, you then have the full idea of what is left each month for you to put away for investment. And this is the time where you would concentrate all of your money into your investment. And remember, you have to stay consistent and you have to invest consistently to see a growth. Here's a typical example. It takes roughly about 10 years for you to reach £100,000. That's a lot of time, and majority of that contribution is going to be your savings alone. You'll be paying up to about £60,000 to grow your wealth to £100,000, and after that it just snowballs. the compounding actually works as magic and it accelerates. And before you know it, you will be making a lot of money over a period of time. So have that patience. Feel comfortable in investing and watch your money grow. Opportunity cost is nothing but what your money could have done if you hadn't put it away for something else. Let's say if you had £50,000 or $50,000 and you invested into something like a property in India, which gave you a return of 1 to 2%, then you have basically used up that 50,000's opportunity to grow somewhere else where it could have grown between 8 to 10%. When you lose that particular opportunity, that's where your money is lost. In your 40s, the opportunity cost hurts more because time is more valuable. Here's the simple rule that helps you gain a better understanding in terms of where your growth journey is in terms of creating your wealth. In your 30s, you're taking risk. So this is the stage where you're growing. In your 40s, you are growing, but you're also subsequently protecting your investment. And when you're in your 50s, you are protecting what you've actually built in the past. If you get these stages right, then in your 50s, you stay calm, you stay stress-free, and your wealth journey becomes a lot more comfortable. Remember, if you're in your 40s and you're investing consistently, you're way ahead of 90% of the people who have not even thought about investing. And in your 40s, you don't need to chase risk. You just need to stay disciplined. You need to stay consistent and focus on having a clarity in terms of what your investment should look like. And in the next video, I'll be breaking down in terms of how you should be investing as an NRI in your 50s. And if you're interested to know more about that, then hit that subscribe button. If this helped you, hit that like button. It helps the channel to grow. As always, I'll see you in the next one.